Welcome to 15th session of Management Accounting, 5th semester BBA, Bengaluru North University. In this session, we are going to solve some simple problems on turnover ratios. In the previous class, we have discussed meaning, types and their significance of turnover ratios. The main objective of this chapter is to familiarize the students with the ratio analysis as a tool for financial analysis. Session outcome. From this session, the students will be able to compute the various ratios that test the activity performance of a business. The first problem is from the following data, calculate stock turnover ratio, debtor turnover ratio and fixed asset turnover ratio. Here trading and profit and loss account is given, that is only trading account is given. Okay, opening stock, purchases, other expenses, gross profit, sales and closing stock is also given. Then closing fixed assets, closing debtors and closing bills receivable is given. Now first we are going to calculate inventory turnover ratio. The formula for that is cost of goods sold divided by average inventory. Now first we have to calculate the cost of goods sold. The formula for that is sales minus gross profit. Sales is given 8,50,000 and gross profit is given 3,40,000. So cost of goods sold is rupees 5,10,000. Then we should calculate the average stock. That is the formula is opening stock plus closing stock divided by 2. Here opening stock is given 99,500. Then closing stock is 1,49,000 divided by 2. Average stock is rupees 1,24,250. Then inventory turnover ratio is equal to 5,10,000 divided by 1,24,250, that is 4.10 times will come. Then we have to calculate the debtor turnover ratio. Here credit sales. In the problem separately credit sales is not given. Only sales is given. That sales we have to consider it as credit sales. Then average debtors. Here opening debtor and only bills receivable is not given. Only closing debtor and closing bills receivable is given. We need to add that. Okay. That is average debtors is equal to 5 lakh plus 1 lakh is equal to 6 lakh. Now debtor turnover ratio is equal to 8,50,000 divided by 6 lakhs, that is 1.4 times will come. Next fixed assets turnover ratio is equal to cost of goods sold divided by fixed asset. So cost of goods sold is 5,10,000 and fixed assets is 4 lakhs. Fixed assets turnover ratio is 1.275 times. Next problem number 2. A company sold goods both on cash and credit. The following information are given below. Total sales is given, cash sales is given, debtors at the end and bills receivable at the end is given. Calculate debtor velocity and debt collection period. Now debtor velocity, the formula is credit sales divided by average debtor. First we should calculate credit sales because it is not given in the problem. Only total sales and cash sales is given. So formula for that credit sales is total sales minus cash sales. Total sales is 2 lakhs, cash sales is 20,000. Then credit sales is rupees 1,80,000. Then average debtors, only closing debtor and closing bills receivable is given. We need to add these two. So average debtors is 1,10,000 will come. Next debtor velocity is equal to 1,80,000 divided by 1,10,000 means 1.63 times will come. Then debt collection period. The formula is 365 days divided by debtor turnover ratio. So debt collection period is equal to 365 days divided by 1.63 is 223 days will come. Next, third one. Third problem, calculate creditor turnover ratio and average payment period. Then what are the information that is given here? Credit purchases is given and creditors on 1st January and creditors on 31st January, that is opening and closing creditors are given. All the information it is given directly. Okay, creditor turnover ratio. The formula is credit purchases divided by average creditors. So credit purchases it is given in the problem. Then we need to calculate average creditors is equal to opening creditor plus closing creditor divided by 2. So opening creditor is 80,000, closing creditor is 60,000 divided by 2. Average creditors is 70,000. Then creditor turnover ratio is equal to 6,80,000 divided by 70,000 is 9.71 times. Next, average payment period. The formula is 365 days divided by creditor turnover ratio. So average payment period is equal to 365 days divided by creditor turnover ratio is 9.71. Now average payment period will come 38 days. Next, problem number 4. Calculate creditor turnover ratio from the following information given below. Here opening creditors is given, purchases return is given, cash paid to creditors is given, closing creditors is given. Okay, here credit purchases is not given. With the help of all the information, first we need to prepare creditors account. From that we can able to calculate the purchases, credit purchases. Then we can calculate creditor turnover ratio. See, first we are preparing the creditors account. In the creditors account, opening balance, opening creditor should be right on credit side, by balance brought down 50,000, then purchases return debit side, then cash debit side we have to write, closing creditor we have to write on debit side. Then the balancing figure is the credit purchases, that is 2,50,000. Then creditor turnover ratio is equal to, formula is credit purchases divided by average creditor. With the help of this creditors account, we have calculated the credit purchases, that is 2,50,000. Then we have to calculate the average creditor. The formula for that is opening creditor plus closing creditor divided by 2. So if we substitute, we are getting average creditor is rupees 40,000. Then creditor turnover ratio is equal to 2,50,000 divided by 40,000 means 6.25 times will come. Next problem. Opening and closing balances of debtors are 40,000 and 60,000. Debtor velocity 2.4. Calculate credit sale. Here debtor velocity is also called as debtor turnover ratio. Here opening and closing debtors are given. With the help of that we can calculate the average debtor. Average debtor is equal to opening debtor plus closing debtor divided by 2. So if we substitute, we are getting average debtor 50,000. Then debtor velocity, the formula is credit sales divided by average debtors. Debtor velocity is given 2.4. Credit sales we need to calculate. Then average debtors already calculated 50,000. If we simplify, we are getting credit sales rupees 1,20,000. Next problem. Average stock of a firm is 1,60,000. Opening stock is 20,000 less than closing stock. Find out opening stock and closing stock. It is very interesting problem and also it is very important problem. Here average stock is given. Then opening stock, they are telling that it is 20,000 less than closing stock. If the closing stock is rupees 1 lakh means opening stock is less than 20,000 less than closing stock, that is 1 lakh minus 20,000 means opening stock will be 80,000. Okay, now find out opening stock and closing stock. So first we will treat this closing stock as a X. Therefore, opening stock is equal to X minus 20,000. Means we are treating closing stock as X, then opening stock is X minus 20,000. Then average stock is equal to opening stock plus closing stock divided by 2. We are writing the formula. Average stock that is given in the problem 1,60,000 is equal to opening stock is X minus 20,000 plus closing stock is X divided by 2. Simplify this. 1,60,000 into 2 means 3,20,000. X plus X means 2X minus 20,000. And this minus 20,000 will become plus 20,000 is equal to 2X. Then 2x is equal to 3,40,000. X is equal to 3,40,000 divided by 2 rupees 1,70,000 will come. What do you mean by X? X means closing stock. So the closing stock is 1,70,000. Then opening stock, what we are treating as opening stock? X minus 20,000. Okay, X is 1,70,000 minus 20,000. 1,50,000 is the opening stock. Then average stock of a firm is 50,000. Its opening stock is 10,000 more than its closing stock. What is the main difference between the last problem and the previous? This problem is there it was given opening stock 20,000 less than closing stock was given. But in this problem opening stock 10,000 more than its closing stock is given. For example, if the closing stock is 1 lakh, opening stock will be 10,000 more than means 1 lakh 10,000. Okay, same procedure here also we are following. We are treating closing stock as an X and opening stock is equal to X plus 10,000. And average stock formula we need to write, then substitute, you are getting the answer. Same procedure you have to follow whatever we have followed in the problem number 6. And the last problem for this session is stock turnover ratio is 5 times. Average stock is 60,000 and gross profit on sales is 20,000. Calculate sales and gross profit. Here stock turnover ratio 5 times it is given in the problem that we are taking. Stock turnover ratio, what is the formula? Cost of goods sold divided by average stock. But here we don't know the cost of goods sold or sales also we don't know. Okay, stock turnover ratio 5 as it is we are taking whatever that is given in the problem. Then cost of goods sold we don't know. Average stock is given in the problem. If we simplify, we are getting cost of goods sold rupees 3 lakh. Next, gross profit on sales it is given 20%. But we don't know the sales. We know only cost of goods sold. So we need to convert the percentage. How to convert the percentage? Gross profit is 20% on sales means 25% on cost of goods sold. How means 20 divided by 80 into 100, that is 25%. So gross profit is equal to cost of goods sold, that is 3 lakh into 25%, 75,000 will come. Sales is equal to cost of goods sold plus gross profit. So sales is equal to 3 lakh plus 75,000 means 3 lakh 75,000 will come. Next, multiple choice questions. The first one is average stock is equal to opening stock plus closing stock divided by dash. Options available are 1, 2, 3, 4. The correct answer is 2. Next, second question. Credit sales is equal to total sales minus dash. First options are cash sales, cash purchases, credit purchases and none of the above. The correct answer is cash sales. The third question is debtor velocity is equal to dash divided by average debtors. Options are cash sales, cash purchases, credit purchases, credit sales. The correct answer is credit sales. The next question. Stock turnover ratio is equal to cost of goods sold divided by dash. Options are stock, opening stock, closing stock, average stock. The correct answer is average stock. Then, fifth one, dash is equal to cost of goods sold plus gross profit. Options available are cash sales, credit sales, none of the above. The correct answer is sales. You can refer these textbooks. Thank you.